The concept of a value stock is when a stock is trading for less than its intrinsic value. Intrinsic value is, in theory, what a company is worth using fundamental analysis to a fully informed investor. One perceived advantage of a value stock is that they carry less risk. The logic here is that if a company is worth $50 a share, according to the investor's calculation of intrinsic value, but the stock is currently trading at $40 per share, well, if the investor buys at $40, in time the market should realize that the stock is truly worth $50 per share, and the stock will rise the 25%. Even if the stock were to temporarily fall from the current price of $40, the question for the value investor is, did we properly calculate intrinsic value? If we did, well then we're less concerned about the current price, because as Warren Buffett put it, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This quote nicely captures the concept of value investing. In the short run, people in the markets can be irrational, but over time, in the long run, things will be priced at or near where they should be based on the true value of the company. The next logical question is, how do we calculate intrinsic value? Well, there are a variety of different methods, each of which will be covered in depth in future videos. But briefly, here are two popular methods used to calculate intrinsic value. One method is discounted cash flow. This is where the investor projects how much cash flow a company will generate in the coming years and then discounts future cash flows to today. When a cash flow is discounted back to today, this basically means that it accounts for the fact that cash is worth more today than it is next year or some other time in the future. This is known as the time value of money. Another method, using the same principles as discounted cash flow, is the dividend discount model. To use the dividend discount model, you need to project future dividends instead of future cash flows. The principle here is that what is valuable to the investor is how much cash they can get from an investment. Once again, those dividends are discounted back to today, which will give the implied intrinsic value for that company. If it is trading for less than that, it could be a value opportunity. Both the discounted cash flow and the dividend discount model are intended to calculate intrinsic value. But another popular method to identify value stocks is to simply compare a company to its peers. So if company A is trading at a price-to-earnings ratio of 20x and company B is trading at 15x, well then perhaps company B is a value opportunity. It would make sense to go beyond just comparing two stocks. I would probably want to throw in at least a few more, and perhaps the industry average and the S&P 500 average as well. That way you will have much more complete data to work with. One pitfall to watch out for when looking for value stocks is what is known as the value trap. A value trap is when a stock looks like it's trading at a discount to peers or intrinsic value, but in fact it deserves to be. Perhaps their margins are weaker than peers, or they have too much debt, or the outlook for this particular company doesn't have great prospects. This is why investors need to go beyond the numbers and need to try to understand the why behind the numbers. Once you find a company with good numbers and then you determine the why behind it, value investments can be a fantastic opportunity. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.